Welcome to another Market Insight Call where we sift through the noise to get to the signal, give you actionable advice so you can make informed decisions. Joining me this month is Chris. Chris, we're in the month of May. You know what that means. There's the old saying, sell in May and come back in St. Crispin's Day, or now November. I don't think it rhymes as much. But really, whenever you're cutting out October, that probably is the reason that looks so good historically. So we're going to get into what we see going forward today. Also, it's the month of May. That means June is after Memorial Day. You know what that also means? The seersucker suit again.
Oh, gosh.
So I'll be looking forward to those. I got several months that I can wear the seersucker. Hopefully I can do it for each one. But you're really driving the slides today, so why don't we jump right into it?
Yeah, so first thing is just the S&P 500. Looking back since last March, March of 22, same timeline we'll use when we're talking about the Fed starting to raise rates. And we can really see we are in this range-bound market looking back all the way up to March of this year. Now, the peak out at about 4,200, pretty strong resistance at 4,200. That's the dashed red line going across the screen. Dashed green line, support. Okay support around that 4,000. And below that, we have our moving averages. Right. The shorter term, 50-day, that's the blue line. It's moving up, short-term uptrend. And then the red line is a little bit more intermediate, 200-day moving average, also moving up. So we see these moving averages that are moving up, and then a market that's consolidating right now within these ranges.
Right, so we really haven't seen any good downward pressure since October, and that really probably priced in most of what we're dealing with in the headline risk. We're not saying that the economy looks great and it's humming on all cylinders. We're saying that it's probably priced in most of this data, especially not only are we in those uptrends with the 50-day and the 200, but we have that 50-day above the 200, which is a good sign. Why don't we?
We'll start by closing out some earnings, and then talk about some things that could either break to the upside outside of this trading range or down to the downside, some more risk events. So our last call was on 4/11, and before that we pulled the data for earnings on what the market was really expecting to see throughout the quarter, and we're almost done reporting. The bulk of the S&P 500 is done reporting for earnings season, so we have pretty good numbers on where that is. So if we look here at the red box, and again, this is old data of what the market was expecting. 219.83 earnings per share on the year for the S&P 500, specifically on the quarter, 50.63, which is a 7.7% decrease in earnings of what people were expecting.
And this is what they were expecting, right?
So what we actually got, and we look at the center red box, the S&P 500, it's the top part, down 2.5%. So heading into it, expecting down 7.7, and really we did get earnings decline. Obviously, it was very expected, but it wasn't nearly as much as expected.
And there's a 5% upside swing.
Exactly, and you could pull any specific sector. There were a bunch of beats across the board, but specifically tech, people were really pretty worried about tech. It makes up a large part of the S&P 500, and so does consumer discretionary, because Amazon's technically part of discretionary, even though a lot of people categorize it as tech. Same thing with consumer communication services, because that gets the advertising companies like Meta and Alphabet, who also reported okay earnings. But the one thing to note is you had lower expectations. We're not saying these were the best numbers we've ever seen.
Actually, they were pretty low, right? The expectations were they were pricing in a pretty severe drop in earnings that has not yet materialized.
Which is to be expected when the market's down 15% plus and even more in a lot of these names. But what we saw was if you had a positive beat, well, you were only up a little bit, 0.3%. That's the left-hand side, the blue, and then the average on that is 1%. So companies were not being rewarded for significant beats on average, but they were being punished. The right-hand side, if you had a negative surprise, you were down over 4%, and typically it's only about 2%.
So basically the market's saying, we don't expect much from you, but we've given you such a low threshold. If you beat that low threshold, we're not celebrating it. But if you miss that low bar, you're going to get severely punished. And to your point, we're seeing that in this data.
A couple of good things we did here is the amount of management teams talking about inflation on their calls has come down a lot. So on the far side, it's dashed in gray because there's still 40 companies that haven't reported. But even if all 40 cited inflation, we're still in a significant downtrend of companies no longer saying that inflation's worrying them. I know in our strategy with Moat, we had a good example from Pepsi where they said they're done raising prices. They've done a lot of raising prices for inflation over the last 18 months, and they think they're where they need to be. They don't see that much more increasing on the food side, which is actually what we saw in the CPI report specifically last month on food, came in flat finally.
Mm-hmm. Yeah, so I would say that I typically expect inflation to be worse than many of our peers. We were 18 months ago saying, no, we expect inflation to be pretty high, pretty robust, and last for some time. But when we're seeing bank liquidity issues, et cetera, the Fed pulling back money supply, I think that hot CPI prints are something in the past. I do think unless the Fed is going to reverse course, the inflation is probably going to come back to more normal. Whether we get down to that 2% target is another story, but I think I agree that the inflation expectations are not going to be nearly as high as they were.
And as far as beating these earnings, we can look to where earnings are going the rest of the year, where analysts are seeing it going. They have not raised their targets. We said 219.8 was where we entered the season at. Well, we're leaving at expectations for the full year at about 221. So slight increases from where we started because the quarter was stronger, but the expectations are still pretty low heading into the rest of the year. And this is from LPL Research. If you take their specific number of what they're expecting about 213, and they may trim equities a little bit, but it's not. They're expecting 213, and they're not saying sell all your equities.
So they're still pricing in
Yes.
a pretty soft economy and a soft business environment.
And the main thing we've been seeing in performance is this divergence. Last call, we talked a lot about how only a handful of sectors were performing well on the year. That hasn't changed.
Right.
So what I pulled here was the mega cap divergence. So I didn't want it to just be a couple sectors. As we mentioned, Amazon's not technology, it's discretionary, and Alphabet is also not technology, it's in communication services. So I pulled Vanguard's mega cap growth ETF. And that thing is up 4.4% since our last call on the 11th of April. Well, the S&P's up about 80 basis points, and the equal weight S&P 500, which takes all the 500 stocks and equally weights them, so 20 basis points weighting per stock versus the S&P, which does cap weighted. And Apple's over 7% weighting in the S&P now. So as far as concentration risk in just the index that everyone quotes, that's growing pretty high. But the average stock is not performing very well. That's
Right.
why we're seeing that RSP down almost 2% since our last call, while mega cap has continued to perform well.
And this has not really been a strange thing for the last, I would say, decade and a half. The few times that it's gone against us, which it went against us in the previous year, is whenever interest rates are moving up, that finally some of these mega caps pull back. But now with interest rates kind of stabilizing, inflation stabilizing, it's not a surprise to see these things jump back out. And it's one of the things that over the last couple of months we were rotating back to the larger firms coming out of small cap with this. So we were able to get that one fairly right, and we're starting to see those numbers in performance to finally come back after that value rotations come back out, and now we're seeing that. Do you expect this to continue on for the near to intermediate term?
I do. We did run some numbers on when technology as a sector outperforms. And when it's outperforming significantly, typically what's called overbought range tends to remain overbought for a while and continues to outperform on the 6 to 18 month time frame. So we talked about having a little bit too much concentration in single names. So we're not overweighting it significantly. It's a small overweight, a couple percent. To capture some of this trend. They seem to have found, really the way to do it is just to mention all their AI.
It's artificial intelligence it is definitely being mentioned a lot, and the market seems to want to reward that. It kind of reminds me of the 1990s on this question on productivity, and Greenspan and a lot of economists were looking at it, trying to understand how the computer age was going to affect productivity. There's a lot of investment in companies, but it really didn't show up for some time, but eventually did. Now, early on, if you would have bought that in the 90s, you're doing great. Obviously, they overinvested on that. I wouldn't be surprised if we see something similar here with AI. I think it's going to increase the profit margins on companies, and we'll probably start to see some of that effect 18 months out and further, and I think the market is rewarding that. obviously, if you continue to go out there and you advocate this as your strategy and you invest heavily in this, what happened in 2001? Well, people over-invested in a good thing, and eventually we have a correction. I wouldn't say AI is anywhere near bubble prices. I don't even think we've really fully comprehended how much of an impact this is going to have, but it's going to have a positive impact for companies because it's going to make people far more capable, it's going to make communication a lot more clear, and it's going to be able to really gather a lot of data. So I think this is something that we can think about like the internet revolution, where it just changed the way in the access of information in a very strong way to keep inflation and productivity numbers looking very good, and it was great for the market. I think we're going to see that here, and obviously if you overinvest in there, there's always the risk that it gets to bubble valuations, but I wouldn't say we're anywhere near that.
And our exposure to AI at this point is through profitable companies, regardless of AI,
yes.
Right? It's an addition to their business, and the market is getting excited about it and rewarding it when they're having meetings talking about this.
And a lot of these larger companies really are information companies, and when you think of AI, that's the sweet spot, right? So they're going to benefit even more from that. I know you have a slide on those large companies.
Mm-hmm. Yeah, I pulled just the largest companies in the S&P 500. I wanted to see just how did their earnings show up. It's not just that they're mentioning AI, of course. They were able to get expectations low enough for some pretty strong beats. So this is, you can see in the fourth column, it's market cap. So the largest company, Apple, at $2.7 trillion market cap. And then the far right column is earnings surprise above the expectation. And everywhere except Tesla, which we have pretty low exposure to, is significantly beating their earnings.
Right.
So it was a pretty good quarter from earnings standpoint in the large cap as well, the mega cap.
Right. And do you expect to continue to see them to be able to ride this for a while?
They're able to handle the cost pressures as well with the margins coming down. So that helped a lot. And when we look at other risk events through the rest of the month, we talk about earnings season. It's almost over, right? That was the last month. Coming forward, we have PCE a couple weeks on the 26th, and then another CPI in June. Last CPI report came in okay. We'll talk about that too. The FOMC meeting was on June 14th, and the market's starting to price in a pause, so no more interest rate raises. And this week specifically, 14 Fed speakers. Seems a little much. They were all out talking, and of course Treasury reaching its debt limit will be our final risk event that we'll talk about. So CPI, the yellow bars are headlines. So that includes food and energy. And we can see over 2022, we're coming down significantly.
Right.
We're able to get a number finally below 5%, 4.9. The market did like this. Core is lagging a little bit. We can still, the trend is still good, still a downward trend. But it's not moving down as strong. It has some shelter components that lag significantly.
And we've talked about that in previous market insights where we expected inflation because of the shelter and the way that index is constructed to kind of take a while to process through. One, we didn't realize all of it that we needed to at the beginning. That was kind of muting the CPI, so it wasn't as high as it could be. Well, now it makes sense that now that the CPI is dropping, it's going to kind of keep it there and a little elevated for some time, but I don't see any reason why there is a real significant economic change in shelter where those prices are going to continue to go up. I expect this to be a gradual decrease as those numbers kind of work their way through.
Yeah. And so what the Fed said at their last meeting is that they changed some of their language. Instead, they've been talking in the past of ongoing rate increases that were needed. Mm-hmm. And now it's, well, we're going to wait and see. We're going to evaluate what's coming forward. Well, what's up next? The PCE report that we talked about for a measure of inflation, that's their favorite measure. Mm-hmm. And then another CPI report the day before their press conference and decision. So when we look at what the Fed's done the last year, top panel is the lower limit on their rates. Started at 0 in March of 22, raised 500 basis points over the next 14 months. So we're at this range of 5 to 5.25. Pretty high, a lot higher than they originally anticipated.
We haven't seen these interest rates in quite some time.
And when we look down at the bottom of this panel, it is the market expectations for what they're going to do at the next meeting. So 78% probability is put on no change, that there will be a Fed pause at this meeting. Still a chance of 21%. And so the risk that we see here is if those inflation reports come in hot, you're going to see the probabilities change. And that's going to be a market that's probably going to be down a few percent.
Would you consider yourself in the 78% or the 21%?
I'm in the 78%.
I think I would agree too, especially whenever we have a 5.5% Fed rate and we got inflation coming in the threes, right? It's been a long time since you could get real interest rate earnings above inflation, and we're certainly there. So then what's the justification of continuing to increase rates? I think the probabilities, even if we did have a higher CPI, I don't think it's going to change that much because from my standpoint, I think the Fed is done.
We know they watch this, so if there is something that changes and this starts coming down 50-50, they'll say, all right, the market thinks we can do it, and they'll go through with it.
Sure.
If it remains here, they're unlikely to keep surprising. And one of those reasons is we can look at their last projection. So in that red box is the 2023 end of year, what they said, what their expectations were going to be to close the year. And the majority, about half the dots, are right in that 5.5. So half the members are saying, hey, we think we're done here. But there are still a handful, 7 more above that say maybe there's a little bit more. So, well, we know Fed pause is important for the market. We've talked about it multiple times. I don't really want to spend too much time here because we spent a bunch of time on it last call, but average returns after a pause, they're up. So when you look out 3 to 18 to 12 months, they just continue to be higher on average returns.
Right. So that's a really strong bull case if we do have that pause. Even on this one or the next one, there are good returns historically after a pause that we can look at as expectations for the market.
We've been talking about it for a while. We might finally be here for the pause. It looks like almost an 80% likelihood. We got a bunch of Fed speakers, and the market does listen to them. They can move the market significantly while they're talking. And on Friday, to close it out, is actually Powell. He's at a conference with Bernanke, actually. And just as a little bit of a joke, I pulled some of their quotes that may or may not age. One didn't age well at all. From Bernanke in 2007 saying subprime was contained, and Powell this time around is saying that banking is sound and resilient.
Well, I like picking on Bernanke. I don't think this is his worst. I think the time that he said he didn't buy the premise that real estate could go down, I would much rather have that one stuck on my name than that one. And if I have to choose between these, I would rather take Powell's because Powell is the Fed, and the U.S. banking system is the Fed. And if they're saying it's sound and it's resilient, well, they're the ones that are able to increase the money supply, so they can make that be the case. The only question the only thing that they can't control is the purchasing power of the currency. But as in the ability for the banking system to meet its obligations, they have full control on that.
And then the final risk event we had is really Treasury. And this is going to be headline to headline, where the market's going to be moving out. You don't know when this could change, even by the time videos are put up. And what we're seeing is Yellen saying time's running out, talking about Treasury running out of money in early June. And you can see that here at the chart of just their cash balance. The drain is coming down, heading towards $100 billion. And I don't really often agree with a lot that she has to say recently, but her remarks on what will happen if Treasury doesn't meet these obligations I think she's right on it. She said there will be financial breaks in the economy, panic, margin calls, runs, fire sales. We talk about breaks in the economy a lot, and it's a pretty vague term. It typically means no one saw it coming. If they saw it coming, they could have done something to stop it. So like the banking crisis that started with duration mismatches in your assets from rates being raised so quickly, not a whole lot of people saw that coming, or else there would have been ways to stop it heading into it.
But the debt ceiling is pretty well telegraphed, right? We do see this coming. The market isn't responding to it. I would think I know for me, I'm going to be turning 45 this year. I'm kind of tired of this game that's constantly played with this, and they always come into the 11th hour. So let's hope that they get this resolved because of the severity. They typically always do because of the severity. But I think the overall market is kind of tired of the game where we play this.
But to that point, they haven't priced much of it in.
Right.
We'll see 50 basis point moves when they hear that staff meetings aren't going well, or McCarthy and Biden aren't really talking well, or talking past each other completely.
Right.
So the market could still have a significant downside break if they actually have to start to price in some of this, at least on the equity side.
Right.
We can look historically to the 2011 example, because that's widely regarded as the similar time when you didn't have agreements, and they waited till the 11th hour, like you said, and the S&P 500 was down 17%.
Right.
But
then
1 year later, up 28%.
Right.
So it recovered very quickly. Now, I don't expect a very, very strong recovery because we haven't priced much of it in. But if we do see significant downside, we expect in the next year that the recovery will happen.
Right, because everyone always gets the money. It's just whether you get it in time, which in a modern finance world, the timing of money is vitally important. So it makes sense that you would have a sell-off, but they're going to meet the obligations. So if we did get into that situation, the market hasn't priced any of this in, and we start to see that sell-off, that would actually be a good time to start taking on risk, because we know that it's going to be resolved, and the market's just kind of in this state of capitulation as they're trying to figure that out. And that would be a good time to actually provide some liquidity by going into the market, which I think we're well positioned to do if that was the case.
Yeah, when it comes to any strategy changes, we haven't really made any changes that are worth noting on the call, right? We've seen, like we said, a short-term, very short-term trading range, but we're still in this slight uptrend. And so all of our strategies were really positioned well for that and are performing
so
well.
There's just been no changes really since we met last. We had been positioned for this by going up U.S. large cap, moving from small cap. I'd say one of the areas that we've kind of tried to catch up, and thankfully we have that overweight to U.S. large cap, is some international exposure. We've been slowly adding there and continue to do so, but as you said, there really hasn't been any big trades this month, because what we did and put in place has been working, and it's been working well.
And finally, I just want to talk about the strategy that we've been putting together in terms of investing cash, a cash alternative strategy. So this is what we've been doing for hub accounts, which historically we've held between 10 to 24 months of cash. So we created this laddered strategy to invest across a risk spectrum depending on how much time you have before needing the cash.
Right.
So the very short bucket is cash that's absolutely needed. We're going to be taking withdrawals from it, right? The idea of the strategy is to meet distributions. So we need something that's in a cash sweep product. But outside of that, you only need a few months of that. When we start looking at these month labels, they're more guidelines, but they'll hold in the long term. We can start looking at the second bucket, cash equivalents, where you can earn yields over 4% now. And when we move out further, 10 to 16 months, that's the spot where we'll want to take advantage of term premiums with the Treasury curve. Right now, there is no term premium because the curve is so inverted. So right now, it makes sense to just live in that second bucket that's getting the very short-term rates. But in the long run, we'll have an upward sloping yield curve, and you'll want to hold securities that mature in 10 months versus money funds, which can only hold 60-day weighted average maturity. And the final bucket is credit. That's out when you have much more time, say 2 years to needing the funds, you can start to get yield that's even higher, say over 5.5%.
Historically, we have said, well, we didn't charge on cash, and we would just hold it in brokerage accounts and where there weren't any expenses. And we did this cash management for people. And the reason is because it was really difficult, if not impossible, to actually generate value for a client, because you earn 0% anywhere and everywhere, and putting them in a strategy that charged an advisory fee was just going to ding you because you couldn't make that up. And now it's a different environment where we think we can add some value here for cash management. And so we do have this new strategy. And the question is, well, are we going to go back to 0% and be able to lose that ability to generate value for clients? And I personally don't think so. I think the era of a very low inflation rate, a very low to zero interest rate is probably past us. A lot of that, if you just think about demographics, you had baby boomers in their peak earning years really being able to save a lot. There's a lot of excess capital to lend out. Well, they're retiring. And my generation, Generation X, is not nearly the size. We're in our peak earning years, but we can't invest in that savings relative to what the boomers are actually depleting, because now they're selling those assets. And then we have the millennials who are not yet in their peak earning years, but they're also in their peak consuming years, where the baby boomers are not consuming. So now we're going to have inflation from them consuming as a large demographic, and we don't have near the amount of savings. And this is not just a U.S. phenomenon. This is a global phenomenon. And then we could even talk about the multipolar world, the slowdown of globalization just in time, where there's going to be a lot of redundancy put in there. So I think inflation and interest rates probably are coming down from where they are right now, but I do not think they're going to come back down to zero. So I think we'll be able to add some value here, which we haven't been able to do for really over a decade.
And in that scenario where you have 0% interest rates, we've seen people it's not what you're earning on your cash.
Right.
Your equities had the largest bull market we've
Right.
ever seen. At that point, you want to make sure you have the right allocation across not these buckets, but backing out and looking at your equity, fixed income, and cash bucket. So being more involved in that is what becomes really important when you're at the zero
Right,
bound.
'cause if
So if it does happen.
If you're still heavy equity, which we continue to say that clients should overemphasize equity, then you're not worried about your cash because the equity is going to go back up whenever those interest rates drop down to zero. Anything else that we want to cover here? Well, we really appreciate you tuning in for Market Insights. We want to thank Dan for getting the lights turned on. We actually think it might have been the remote battery wasn't in there, so we'll pay a little bit more attention to that remote battery. If you haven't subscribed, go ahead and that subscribe button. Please share the video with any friends that would have some considerations or concerns or just trying to get some good market insight. And make sure you hit that like button to get that vote for a seersucker suit. The more likes that I get, the more months that I'll wear them through the months that I can. And we just thank you for joining us, and we'll see you again next month.